Value versus growth. Can contrarian investing thrive in undervalued sectors and ETFs? The age-old debate in investing value versus growth has taken on new fervor in the wake of 2022's market turmoil. Growth stocks, once darlings of the pandemic era, have seen their valuations plummet, while undervalued sectors like energy and financials have staged surprise comebacks. This resurgence has rekindled interest in contrarian investing, the strategy of betting against prevailing trends and seeking bargains in the market's neglected corners. But can contrarianism, particularly focused on undervalued sectors and ETFs, thrive in the current environment? To explore this question, let's delve into a Q&A format here. What exactly is contrarian investing? Contrarian investing involves taking bets against prevailing market sentiment. It's about swimming against the tide, buying assets when others are selling and selling when others are buying. The core belief is that markets overreact to both good and bad news, creating temporary mispricings that savvy investors can exploit. Why has contrarianism returned to prominence? The recent market correction, particularly the drubbing of growth stocks, has exposed the potential dangers of chasing momentum. Investors are now looking for value and protection, leading them to sectors that were previously sidelined. Additionally, the relative underperformance of traditional growth sectors has made undervalued areas look more attractive in comparison. Which sectors are currently considered undervalued? Several sectors have been beaten down significantly in recent times, making them potential targets for contrarian investors. Energy. The surge in oil and gas prices has boosted energy companies, making them appear undervalued compared to their pre-pandemic levels. Energy ETFs like XLE and VDE have seen strong inflows as investors seek to capitalize on this trend. Financials. Rising interest rates are expected to benefit banks and other financial institutions. Despite concerns about a potential recession, the financial sector appears relatively attractive compared to its historical valuations. XLF and SPY are popular ETFs in this space. Consumer staples. Defensive sectors like consumer staples, which offer essential goods and services, tend to fare well during economic downturns. ETFs like XLP and VDC provide exposure to companies like Procter & Gamble and Kraft Heinz. Value rights. Real estate investment trusts, REITs, focused on properties like apartments and warehouses have seen their valuations drop due to rising interest rates. However, their income-generating capabilities remain attractive, particularly for long-term investors. VNQ and RWR are some examples of value-oriented REIT ETFs. Are there any specific ETFs that cater to a contrarian approach? While not explicitly designated as contrarian, several ETFs tilt towards undervalued sectors or employ strategies that align with contrarian principles. Deep value ETFs. These ETFs target stocks with exceptionally low valuations relative to their fundamentals, such as PBR and DVP. Anti-momentum ETFs. These ETFs short or underweight stocks with the most significant recent price momentum, essentially betting on a mean reversion. HDV and SURE are examples. Factor-based ETFs. Some factor-based ETFs, like those focusing on value, size, or quality, inherently tilt towards less popular or out-of-favor sectors. These can be incorporated into a contrarian portfolio alongside sector-specific ETFs. What are the potential benefits and risks of a contrarian approach using undervalued sectors and ETFs? Benefits. Exploiting market inefficiencies. Contrary to popular belief, markets are not always efficient. Contrarian investors can potentially profit from overreactions and mispricings, especially in neglected sectors. Diversification. Investing in undervalued sectors can provide diversification benefits, reducing overall portfolio volatility and offering protection against market downturns. Long-term potential. Undervalued companies and sectors, if they experience a turnaround, can generate significant returns for contrarian investors. Risks. Going against the crowd. Contrarian investing requires patience and the ability to withstand short-term pressure. Ignoring prevailing market sentiment can be emotionally challenging, and contrarian bets may take time to pay off. Valuation traps. Not all undervalued sectors or companies are good contrarian plays. Some may be cheap for legitimate reasons, such as poor fundamentals or structural headwinds. Careful analysis is crucial to avoid value traps. Market downturns. Even undervalued sectors can suffer during market downturns. Contrarian portfolios may experience temporary losses before the contrarian thesis plays out. The future of contrarianism. Is it a viable long-term strategy? While market cycles and investor behavior evolve, the core principles of contrarian investing remain relevant. As long as markets exhibit overreactions and mispricings, there will be opportunities for contrarian investors to exploit. However, the specific sectors and strategies that offer the most significant contrarian opportunities might change over time. Adaptability, thorough research, and a long-term perspective will be key for contrarian investors to navigate the ever-changing market landscape and achieve success. In conclusion, contrarian investing, particularly focused on undervalued sectors and ETFs, can be a viable strategy for patient and diligent investors. By understanding the risks and rewards, conducting thorough research, and diversifying wisely, individuals can potentially capitalize on market inefficiencies and generate attractive returns over the long term. However, remember that contrarianism is not a guaranteed path to success, and it requires discipline, emotional resilience, and a willingness to go against the crowd. Carefully evaluate your risk tolerance, investment goals, and time horizon before embarking on a contrarian journey.